All right, today we're pulling back the curtain on the world's biggest financial market. We're going to talk about the partners you absolutely need to trade currencies, how they work, the risks you might not see, and most importantly, how you can make a really smart choice.
Okay, so let's just jump right in. Imagine this massive, super exclusive club. Inside, huge banks are trading trillions of dollars every single day. That's the interbank market. And for you, as an individual trader, well, you can't just walk in. Your name's not on the list.
And that's the big question, isn't it? Well, the answer is you need a certain kind of financial gatekeeper. And honestly, understanding who they are and how they really operate is probably the single most important first step you'll take on your trading journey. Which brings us right to the main event of today's explainer, the Forex broker. These are the folks who hold the key. They are the essential link that connects you to that massive global currency market. The best way to think about them is like a bridge. So on one side of a huge canyon, there's you, the retail trader. On the other side is this vast, kind of complicated ocean of global currency. The broker is the one who builds the bridge, gives you the platform, the tools, everything you need to get across and start placing your trades. But here is where things get really interesting. Because you know what? Not all brokers are the same. Not even close. They basically run on two completely different business models, and the difference between them can seriously impact your trading. So at the highest level, you can pretty much split all brokers into two big camps. On one side, you've got dealing desk brokers. They kind of create their own little private market just for you. And on the other, you've got non-dealing desk brokers who are more like a direct pipeline to the real thing. Now this right here, this is where we get into the nuts and bolts. A dealing desk broker, or what we call a market maker, is literally taking the other side of your trade. You click buy, they are selling to you. They make their money from the spread, that tiny difference between the buy and sell price. Now, you can probably see the potential conflict of interest here, right? If you lose on a trade, they actually win that money. A non-dealing desk broker, though, does something totally different. They pass your orders straight through to the big players, the liquidity providers, and they just take a small commission for the service. Their profit comes from you trading, not from you losing. And this just adds another layer to it. Some of those dealing desk brokers run this internal sorting system. It's fascinating. If their algorithm tags you as a consistently profitable trader, they might put you in what they call their A book, and they'll pass your trades on to the real market to cover themselves. But if they think you're likely to lose, you land in the B book, where they keep your trades in-house and are literally betting against you.
Okay, so with all of that in mind, how in the world do you pick the right partner and, not get burned? Let's walk through a really practical, step-by-step checklist you can use.
Think of this checklist as your shield, and number one is the most important: regulation. It is absolutely non-negotiable. It's the very first thing you check. Once that's sorted, then you can dive into the details. You start comparing trading costs. You check how good their execution is. Make sure they support the platform you want to use. And then you go see what other real traders are saying about them online. Seriously, following these steps is your best protection. So what does that look like? Before you do anything else, you scroll to the bottom of a broker's website and you look for the logos of these top-tier regulators. We're talking about agencies like the FCA in the UK, ASIC in Australia, or CISEC in Europe. See, regulation isn't just some fancy badge. It means there are rules, it means your money is kept safe and separate, and that you have someone to go to if things go wrong. It's your safety net. All right, let's switch gears for a minute and talk about something that's become super popular lately for getting trading capital: the proprietary firm, or prop firm. The idea is amazing, but you have to be careful, because this model comes with its own set of pretty big risks. I mean, the appeal is obvious, right? You pay a pretty small fee to take a challenge. If you can prove your skills, hit their profit targets without breaking the rules, they'll give you a big funded account to trade, and you get to keep a huge chunk of the profits. It really does sound like the dream scenario for a new trader. But you have to ask yourself this one simple, crucial question. If you make a profit, where is that money actually coming from? If you're not trading with real money in the real market, how are they paying you? The answer to that question reveals the entire business model. So here's the uncomfortable truth about a lot of these firms. That funded account they give you, it's often just another demo account. Your trades never actually go to the real market. The firm pays out your profits directly from their own company revenue. And where does that revenue come from? Mostly from all the traders who pay the fee for the challenge and then fail, which creates this huge, glaring conflict of interest. A profitable trader isn't helping their business. You are a direct expense to them.
And look, this isn't just some theory. It happens.
Back in 2023, one of the biggest prop firms on the planet, Forex Funds, was shut down by regulators. And the accusations were, well, exactly what we just talked about. They were accused of lying to traders about being funded and even messing with the prices to make sure people failed their challenges. It's a huge wake-up call.
So what's the key takeaway here? You have to be strategic. The smart way to look at prop firms is as a potential stepping stone. They can be a great tool to get some initial capital and prove you've got the skills. But they're not the final destination. The end goal should always be to get to a point where you're trading your own capital in a real, regulated brokerage account.
All right, finally, let's talk about your command center, the actual software where all the action happens. No matter who you're trading with, you'll be using a trading platform to look at charts and place your orders.
Here's a quick look at the big three. You've got TradingView, which is the absolute king of charting and analysis. Then there's MetaTrader, both 4 and 5, which is kind of the industry workhorse, famous for its massive world of automated trading bots. And then there's CTrader, which is really built for pros who need lightning-fast execution.
Oh, and one quick pro tip for you. If you get serious about using any kind of automated strategy, you're going to need a VPS. It's basically just a computer that lives in the cloud and runs 24/7. It makes sure your trading robot never misses an opportunity, even if your power goes out or your internet dies at home.
So let's bring this all back home. After everything we've gone through, it really all boils down to one single critical idea. Your broker is the most important partner you'll ever have in the market. Your entire trading career is built on a foundation of trust, and that trust has to start with picking a partner that's regulated, transparent, and whose interests are actually aligned with yours. And that kind of leaves us with one last thing to think about. For you personally, what is it? Is it the brand name? Is it having the lowest possible costs? Or is it that simple stamp of approval from a top-tier regulator? Figuring that out for yourself is really the key to moving forward with confidence.